In the world of global finance, the strength of the US dollar plays a crucial role. When the dollar rises, it's often seen as a sign of economic confidence. Dollar-based assets like bonds and stocks also tend to go up, leading investors to stockpile dollars as a safe haven. But the story changes when the dollar starts to fall. It sets off a domino effect. Investors begin to dump their assets. And that's exactly what's happening right now. The US dollar index recently closed at 92.3, the lowest in 3 years. This drop comes despite the Fed raising interest rates from near 0% to over 4%. We're now approaching the lowest levels seen during the COVID-19 pandemic. Interestingly, the Russian ruble has surged nearly 40% against the dollar this year. A weakening dollar signals declining global demand for the currency. And that's a big warning sign for dollar-denominated assets. American investors are diversifying their portfolios. Confidence in the U.S. market is slipping, and many are shifting their money to safer assets like gold. Even more concerning, foreign investors are starting to pull their money out of the U.S. That's dangerous, because the U.S. economy heavily depends on foreign capital. This trend actually began years ago, during Trump's trade war. His policies sparked structural inflation and reduced America's purchasing power. Countries started moving away from U.S. products. At the Economic Club of Chicago, Fed Chair Jerome Powell stated, "We're undergoing major policy changes, especially in trade, and they might go against our economic goals. These policies could raise unemployment and drive inflation higher." For years, people believed U.S. incomes would keep rising, and foreign countries would keep buying American assets. But many of those assets are held by foreign investors. And when the dollar drops, they sell. If the trade war continues, the risks will only grow. Ray Dalio warned us, this is a major global shift. If the U.S. wants asset prices to stay high, tariffs need to come down. Currently, foreign investors hold 33% of U.S. government bonds, worth about $8.5 trillion. If they stop buying or begin selling, the consequences for America could be devastating. Several major banks and hedge funds have already seen a 31% drop in their market value. But much of that drop is speculative, investors chasing short-term gains. If bonds aren't profitable, they'll quickly exit, causing major instability. The burden will then fall on the U.S. government and its people. To fill the gap, more dollars will circulate domestically. But more dollars chasing fewer goods means higher prices, more inflation. Global demand for U.S. assets like bonds and stocks helps absorb excess dollars. Without that demand, all the cash gets trapped inside the U.S. economy. It's like a tsunami, driving prices up even further. One of the hardest hit sectors is tourism, which makes up around 10% of the U.S. GDP. Goldman Sachs projects that fewer foreign tourists could shrink the economy by 0.3%, or $9 billion in 2025. Tourist numbers from Asia, Latin America, and the Middle East are down. But the steepest declines are from close allies: Canada down 7%, Mexico down 17%, and the EU down over 14%. High costs and a negative image are pushing tourists away. When Trump imposed tariffs, many hoped it would strengthen the U.S. economy. But in reality, everyday consumers, including tourists, felt the biggest pain. If you visit the U.S. now, you'll face the same high costs Americans do. According to Yale's Budget Lab, effective tariff rates have reached their highest level in 130 years, 25.66%. Even choosing budget options, you'll still pay around 15.66% in added costs. This makes travel to the U.S. expensive and less attractive, reducing foreign demand for U.S. dollars. Trump claimed tariffs would bring in billions daily from exporters. But in truth, U.S. Customs data shows the real figure is just $200 to $500 million per day. Even if consistent all year, that's only $90 billion, far below the projected $1.9 trillion deficit in 2025. So if someone claims tariffs are a solution to national debt, that claim is overly optimistic. Can Trump fix this with a trade deal? Possibly. But trust has eroded, and many countries are diversifying away from U.S. trade. Asia, in particular, is becoming a trade powerhouse. Meanwhile, the U.S. faces stiff resistance. Japan walked out of trade talks with no deal in hand. This signals something is deeply wrong. Japan now faces a 25% tariff on steel and car exports to the U.S. Without a deal, Japan could fall into recession. The U.S. is Japan's key export market, and the breakdown suggests America may have a bigger agenda. Trump claimed big progress was made, but many suspect he wants Japan to join the U.S. in isolating China. That's a tough ask. Japan relies heavily on Chinese imports, especially in tech. Half of Japan's chips are sold to China. Breaking that link could devastate companies like Tokyo Electron. Meanwhile, China is advancing rapidly. Huawei, DeepSeek, and others are closing the tech gap. Japan must choose: sell to China today or risk losing future markets. And that's not an easy choice. Trump also brought up Japan's defense contributions. Japan currently pays $1.4 billion annually for hosting U.S. military bases. But Trump says it's not enough. He claims Japan still owes hundreds of billions for protection. Experts dispute the numbers. But this isn't about facts, it's about narrative. This is starting to look like diplomatic pressure, or even extortion. Access to the U.S. market is at stake. Meanwhile, back home, small businesses are suffering. Like a U.S. toy company that has manufactured in China for 30 years. Not for cheap labor, but for quality and safety. They said, "Every dollar we spend in China supports American workers, truck drivers, warehouse teams, sales staff, and mom-and-pop shops." But now, tariffs have jumped from 20% to 145%. These aren't China's costs. We pay them ourselves. We ship the goods. We pay the taxes. Tariffs are crushing American livelihoods. If one small business is hurting, imagine the pain across millions. Tim Cook, Apple's CEO, warned about the importance of Chinese manufacturing. Tariffs make many business models unsustainable. Small businesses are the backbone of the economy. They create jobs and fuel innovation. But if they can't survive, America's economic future is at risk. Many small business owners were optimistic when Trump won. They hoped for a golden era. But the reality has been the opposite. Tariffs are pushing them toward cuts, layoffs, and bankruptcies. That's why U.S. stocks are so volatile. Everyone's waiting for earnings reports. Big banks like Morgan Stanley and Citibank have already slashed earnings forecasts. J.P. Morgan predicts a 60% chance of U.S. recession, 40% global recession, and only a 20% chance that the U.S. economy survives while others grow. And the so-called Goldilocks scenario, where everything goes just right, has only a 10% chance. If earnings disappoint and companies cut spending, we could witness a sharp downturn in the U.S. market.